Gold has always been the safe haven asset. And when the markets now are rejecting what they were using as a safe haven asset, particularly, it's not just the currencies, but particularly the 10-year Treasury, which is the foundation of the global financial system yet. And it's going like this, but the demand is gone. Not buying treasuries is a run on the dollar. And actually, China and Japan have been instituting that run since, let's see, what year was that? 2013. Honestly, the pricing mechanism, Wall Street's never going to give you good pricing mechanisms because they're about trading. They're not about reality. I think the price, even at the all-time high, all that is a bit of relief from the suppression. We have not seen anything yet.
Gold has always told the truth, whether civilizations wanted to hear it or not. Long before central banks, before paper currencies, before manipulated interest rates and unlimited quantitative easing, gold stood as a final verdict on value. In today's world of failing fiat systems, weaponized debt, and financial engineering, that verdict is about to be delivered. In this urgent and unfiltered conversation, monetary historian Lynette Zang and market analyst Rafi Farber sound the alarm on what they believe is the terminal phase of the US dollar-based financial system. Zang warns that we're witnessing a historic breakdown of trust, not just in currencies, but in the very instruments that once defined global safety, US Treasuries. She says the world's biggest economies, including China and Japan, have quietly been staging a run on the dollar for over a decade, and now the cracks are widening rapidly. In this new reality, gold isn't just a store of value, it's becoming the last safe haven left standing. Rafi Farber doesn't disagree, but he takes it further. He argues that what's coming isn't a shift in belief, it's a systemic unraveling. As treasuries collapse and inflation accelerates, people won't philosophically choose gold. They'll run to it, desperately, because everything else is either burning or broken. He lays out how the dollar is effectively backed by nothing but rotting debt, and why the rise in gold's price is not a signal of optimism, but of collapse. And as he explains, the gold futures market, long accused of suppressing real prices, may finally be losing its grip as physical demand begins to overwhelm the paper facade. This is more than a market update. It's a frontline dispatch from those who've spent years warning of the storm we now find ourselves in. If you're still trusting Wall Street, the Fed, or mainstream narratives to guide your financial future, it might be time to think again. Hit that like button, subscribe, and get ready to hear the kind of analysis the mainstream won't touch, because what Lynette Zang and Rafi Farber are about to lay out could change everything. Let's dive right in.
Well, I absolutely agree with everything that you said about gold, but I want to add in that actually it's not traditional because they've only been around for a bit more than 100 years. Gold has always been the safe haven asset. And when the markets now are rejecting what they were using as a safe haven asset, particularly, it's not just the currencies, but particularly the 10-year Treasury, which is the foundation of the global financial system yet. And it's going like this, but the demand is gone. Not buying treasuries is a run on the dollar. And actually, China and Japan have been instituting that run since, let's see, what year was that? 2013. So the fact that we haven't witnessed it or it hasn't been obvious because private buyers have been going in to make up that slack, I think that's about to get very, very obvious. So gold, I think, looking at gold as money, but actually even greater than that is the fact that gold is now being looked at as the only safe haven asset. Now, we may have a risk on, so you see, cryptocurrencies move, what have you, but on a global basis, we are definitely in a gold rush. And, honestly, the pricing mechanism, Wall Street's never going to give you good pricing mechanisms because they're about trading. They're not about reality. So yeah, I think the price, even at the all-time high, all that is a bit of relief from the suppression. We have not seen anything yet, not anything.
Rafi, your thoughts?
My thoughts on gold being seen as money. Okay, so I'm gonna try to separate. I'm trying to separate like what you're talking about. Well, do people recognize it as money, as if there's going to be some kind of renaissance? People say, "Oh, I recognize that this material is now money, and I will use it in my transactions." There's going to be none of that. It's just going. What's going to happen is that since there are two things primarily on the Federal Reserve's balance sheet, and the dollar is the other side of the Federal Reserve's balance sheet. So when you own a dollar, you own basically a piece in equal proportion of in the proportion that the Fed owns their assets, you own their assets too, because you own this dollar bill that is their issued liability unit. So there are two things on it. There's treasuries and there's some gold. And there's also mortgage-backed securities, so it's also tied into a housing bust, you know. But that let's just leave that aside for a moment. So when other countries start to drop U.S. treasuries, among other reasons, because for good or for bad, the Biden administration just like stole all of Russia's dollar-denominated stuff because they didn't like what it did. And, you know, I'm not saying that was the wrong move or the right move, but when you do that to a country, other countries are going to start saying, you know, maybe I should get rid of this stuff. And so when you going back to the balance sheet, when you have the 99% of the balance sheet is this treasury stuff, when the value of that goes down, the value of the gold has to go up to balance it, right? And so you can either own the gold or you can own this dollar thing, which is like 99% debt and a little bit of gold. I'd rather just own the gold and chuck the treasuries. I've already chucked the treasury. If you own dollars in your bank account, you own treasuries, whether you like it or not, because that's what it is. So in the moment when treasuries are falling and falling and falling, what's going to happen is not people are going to recognize that the gold is money. They're just going to see it's going up and up and up and up, and everything else is going down and down or losing its purchasing power because the consumer prices, I prefer to call it, consumer prices are rising so fast. Then everyone just follows everyone else, not because they have this epiphany, but because that's what everyone's doing. So they just do it.
Now, the futures market in gold has long been accused of being a vehicle for manipulation of the price. Is that game coming to an end? And break down your overall findings for us.
The point of that video was to say that the gold price is not moving up or down with open interest. Open interest has been like stuck at around 450,000 contracts. Out of context, that number doesn't mean anything. But if you look at a chart of open interest going back to 2000, you would see patterns that on spikes in the gold price, open interest goes higher very quickly, and on sell-offs in the gold price, it goes down very quickly. But now we're just seeing these crazy spikes and dumps in the gold price of like triple digits a day, $150 here and there, and like it's come to the point where me personally, I'm like, oh, gold's up 2%. I'm like, oh, okay. Oh, gold's down 2.5%. Oh, okay. That used to be like big, but now it's not. Something else is moving it because the open interest is not moving that much. It's maybe 3 or 4,000 contracts up and down a day, which is like normal. There's no big moves like 20,000 contracts on a huge $200 update. So something else is moving it. It means people or actors who buy gold or sell gold not based on the futures market. They're getting it from somewhere else. Otherwise, the futures open interest number would move, and it's not. So I'm not saying that the futures market has nothing to do with the price. It certainly influences it now. I'm just saying it's not the main thing. It could be that central banks are driving it, or it could be something else. It could be family offices or big, multi-billion-dollar wealth funds that don't know where else to put their money and they're freaking out. Could be that. So about the futures market manipulating, people ask me this question a lot, and the way I answer it is that it's not. I don't think there's any group behind gold manipulation. I'm not saying that there aren't any groups. I'm saying that they don't really matter. and they can snip the price here or there, a few bucks up or down, but the trend they can't stop. It's the existence of the futures market itself that is the manipulation.
As gold asserts itself as the ultimate safe haven amid the crumbling trust in fiat currencies and treasuries, another metal quietly tells a deeper story about where we are and where we're headed. Silver, often overshadowed by gold, plays a critical role as both an economic indicator and a store of value. Its relationship to gold, the gold-to-silver ratio, has historically reflected the health and wealth of civilizations, rising and falling with the tides of prosperity and crisis. Lynette and Rafi explain that this ratio is more than just numbers on a chart. It's a signal of market sentiment, inflation, and confidence. While gold is the fortress, silver is the canary in the coal mine, hinting at shifts beneath the surface that many overlook. In the next segment, we'll dive into silver's powerful symbolism and the forces shaping its price today, including the suppressive influence of central banks and the strange patterns in the futures markets. Understanding silver's movements may well be the key to decoding the future of money itself, and how everyday people can protect their wealth when the old systems falter. Stay tuned. Silver's story is just beginning.
I get asked a lot about the gold-silver ratio, and if we were inside of the cycle that we've been in since 1913, then that coming together makes sense. But that's not really where we are. We're in a transition period, and when you look at those transition periods historically, and I'm referring to a hyperinflationary reset, then what you see is, yes, I do expect that to narrow, but as we go into hyperinflation, gold 100% of the time significantly outperforms. And actually, it outperforms right now as well. So both of those assets, both gold and silver, are severely undervalued. But I look at it more from a functional perspective and what it is that I'm trying to accomplish. I don't really care about the gold silver ratio, because that is a trading mechanism. And for me, this is about a strategy to sustain my standard of living, maintain the wealth that I've accumulated, and be in a position to take advantage of this reset and the future undervaluations in income producing assets. That's really where I stand on it. I do like silver. Personally, I own quite a bit of silver, but that for me is about barterability, being able to go to the gas station or I won't need the grocery store because I'm a farmer now. But, if I needed smaller pieces and I have enough silver to sustain my current standard of living for 10 years and that of my children as well. So I own a lot of silver, but I'm going to tell you right now, no way would I be trading out of it just because that gold silver ratio became more narrow, because I don't get, this is what I've kind of figured out just recently, actually, and I don't know why it took me so long, but where people will be nominally confused looking at the numbers, in other words, looking at the numbers and thinking that those numbers actually mean something. Well, they do mean something, but probably not what you're thinking of. And so since I've been studying this stuff on some level my entire life, I kind of think about money and things differently than most people do. So I don't get blinded by that nominal confusion. Woohoo, gold is going up, silver is going up. Now, on a technical basis, and especially you brought up the Hunt brothers, and we have to understand that a lot of that was government manipulation. That was a threat, and that was government manipulation in the markets. However, when you look at that long-term chart, what you're really witnessing are two huge double cup formations or accumulation patterns in silver. So not only do I think it's going to hit that $50 mark, which again doesn't really matter to me. It's more from a technical perspective, but I believe that it will go far, far beyond that. Just like the true fundamental value of an ounce of gold is over 40 grand an ounce. Is that reflected on Wall Street's contracts? No, because they're just paper contracts. although there are interesting things happening there. It's the same thing with silver. I mean, the fundamental value of an ounce of silver is $2,000. So it's trading at $33. What does that mean? That means if you can understand how to buy an undervalued asset that's in a long-term positive trend, rock and roll hoochie coo, get as much of it as you can, but it's not because it's going up in terms of dollars, right? It's because it will protect you and it will put you in a position to take advantage of the inevitable.
I did a video on this, and I'll just briefly say what I discovered on that. That Gold Charts R Us has this long-term chart going back to, I think, 1100 on the gold to silver ratio. It's not that it's super accurate or anything, but it's a good estimation. And we do know from the Bible, from the Book of Kings 1, I think chapter 7, I think, that during Solomon's time, the value of silver was nothing, because so much gold was being imported to the kingdom that silver was like pennies. They would drop it on the floor, nobody would pick it up. So we know that when society is very, very rich, the gold to silver ratio goes really, really high, meaning silver is relatively worthless. And when society is really, really poor, we know that silver goes much higher relative to gold because everyone's poor and they don't have gold. So in an inflationary world where all the money is fake, so what would a high gold to silver ratio mean? It would mean that people are acting as if they're rich, right? They think that they're rich because they have all these dollars in their account, and so they chase stocks and they chase Bitcoin and they chase all these other things, and that suppresses the price of silver. Gold, I'm not exactly sure why it's going up specifically now. I know why it's going up generally, obviously. But people have these theories that it's central banks. So if central banks are pushing up the price of gold and also everybody else thinks they're relatively rich, then the gold to silver ratio will fly higher. But we've seen it go back down to 15-1, which is the historical ratio from around 1100 to now by that chart. And it's going to go back there again. It did it in 1919. It did it in 1968. It did it in 1980. It's going to do it again. And when it does it again, I plan to get rid of all my silver and buy whatever I can with it. For the sake of the world, because they'll need money. And whatever I can't think of buying, I'll just get gold and lock it in.
Silver's current position in the market reflects a complex interplay of suppressed pricing and distorted demand signals. The gold-to-silver ratio, which has historically averaged around 15-1, remains abnormally elevated, indicating that silver is significantly undervalued relative to gold. This distortion is driven largely by artificial price suppression mechanisms and a lack of genuine market demand for silver, unlike gold, which is increasingly recognized as a safe haven asset. Technically, when the ratio eventually corrects toward its historical norm, silver prices are expected to surge dramatically. This is compounded by the fact that silver has crucial industrial demand components, making its price action sensitive not only to monetary trends, but also to economic activity. The repeated spikes and dips in silver, disconnected from fundamentals and volume, suggest market manipulation via futures and other derivative instruments, yet the historical patterns and the underlying supply-demand imbalance imply that this manipulation is unlikely to hold indefinitely. Investors should closely monitor the gold-to-silver ratio, futures market activity, and physical silver demand to anticipate the tipping point of this imbalance. Positioning ahead of this correction could be key to capturing outsized returns as the markets realign. If you want to stay ahead of these crucial market developments and get deep, data-driven insights on silver, gold, and the broader financial system, make sure to subscribe and hit the notification bell. This channel is dedicated to breaking down complex market signals into actionable intelligence for serious investors. Thanks for watching, and see you in the next one.